Let's talk about chapter 2. It's a little bit longer chapter. It's a lot of new information. I want to everybody to kind of remember that last December, Congress passed sweeping new tax law, and then it was signed into law by President Trump right around Christmas time of last year. And so the tax laws for businesses are very different. I know a lot of you just got done with your individual tax class, and I know that was definitely a topic that came up there also. So I just want to kind of let you know that everything's new. Some of the basic concepts still apply, but there's definitely some newer nuances we have to be aware of as we go through and learn this. So we'll focus a little bit on that too. So chapter 2 um, is basically called Deductions for Qualified Business Income and Pass-Through Entities, and we'll talk about what those mean. Um, they always start out with what they call a big picture at the beginning of every chapter. So the first page of the chapter, it's just page 1 from chapter 2, shows some ladies playing soccer, and it talks about Amy here wanting to start a business. I'll let you read that on your own, but those are always good to read. They kind of give you the answer to the big picture later on in the chapter also. So I'll let you guys just read that on your own, but it's always good. And I know at this point in time, you've gotten this far in your business classes that you're aware of what the various business forms are, and you can see them right there. And we'll talk about all of them throughout the class and how taxes are different for each type of business form. So just make sure you're aware of the forms. We'll get into the nuances here in a bit. So sole proprietorship, obviously one person owns the business. It's not a separable taxable entity. The income simply flows through to the owner's Schedule C. So if you have your own business set up as a sole proprietorship, what you would do is go about starting your business. What you would do, obviously, is get a checking account specifically for your business. Use some kind of accounting software. It could be something very basic like a QuickBooks Online, just something super easy to pay if it's an easier business. And then just keep track of your business's income and expenses separately. And then that would allow you to file a Schedule C. And then your net income or net loss from your Schedule C just simply flows through to the owner's personal 1040. But the business itself is not taxable. And so they're coming back to the big picture here for Amy, and Amy's the volleyball player who wants to set up her own business, and she's got a couple different business ideas, and it just kind of says here that for her, setting up a sole proprietorship would probably be the easiest way to go. So, but it's important to read those big pictures. They give you some really good information. So partnership, very similar to a sole proprietorship. The difference is that a partnership is at least 2 people. It could be many, many people, but the minimum is 2. And then a partnership also has to file an information return called the Form 1065. And the purpose of the 1065 is to compute what the income or loss is on the business, and then the owners report their personal share of that. So let's just say a business is a partnership. It's 50-50 owned by 2 people. If they made $100,000 of taxable income for the year, then each partner would get 50% of that essentially. Some items are reported separately though, so there's a few nuances to it, and we'll have a whole chapter coming up where we'll talk about partnerships and the Form 1065 in more detail, but just be aware of it for now. And so the partners then get a K1, so you file the 1065, then each partner would get a K1 that would show what the percent of ownership was and what percent of income or loss from the partnership that owner should report on his or her personal return. So again, partnerships themselves are not taxable, but you still file the informational return, then the K1, so that the tax ultimately is paid at the owner level. Then you have an S Corp, and just stands for Subchapter S of the tax code. It's a special kind of corporation. It's a separate entity again, but it only pays certain kinds of taxes. Again, it's a flow through. It doesn't pay many taxes. You file a Form 1120-S, but it's very similar to partnership taxation, but it gives you some of the protections of the corporate form. So if you can recall from previous classes you've taken, a corporation has some special protections in terms of liability. And so most people don't like unlimited liability, right? That can be a scary thing. So if a partnership or traditional partnership or proprietorship take on a business loan, then the issue might be that if that business fails, the bank could go after the owner's personal assets. That can include a home, a retirement, a vehicle, you name it. But if those assets are protected, so basically if you use an S corp to go out and get a business loan, only the S corp's assets are at risk. The owner's personal assets are not. So that's a huge advantage in terms of liability. So therefore, it is a popular form. Typically closely owned, family-owned business would be an example of an S corp. Not that many owners, not publicly traded. S corps are not publicly traded. But the C corp is. So the C corp, when you buy the stock of a company on a stock exchange, I'm using an HP computer to record this. A publicly traded company. You might be using Apple computer right now, a publicly traded company. Those are C corps. And what's unique about C corps is double taxation. That's one thing to keep in mind. The other thing is the sweeping tax changes that we had last year. The corporate tax rates came down significantly. It's now a flat tax of 21%. It was in the upper 30s. There was a progressive tax structure anywhere. I want to say the bottom rate was like 10 to 15%, and the highest rate was close to 39%. And they just got rid of that, and now it's just a flat tax of 21%. And you file a Form 1120, and then you pay 21% of your taxable income. So all of your revenues minus all of your expenses, net income, 21% of that, and that's the tax bill for corporations. So corporations are paying less tax now because of that. Now, the double tax, though, is the C corp is a taxable entity, okay? And so a C corp, when it pays a dividend, so I'll use Apple as my example again. Apple pays dividends. So they pay dividends without any tax benefit. There's no tax deduction for paying a dividend. So Apple is taxed on its income, pays dividends to its shareholders, who then receive those dividends and are now also subject to tax. At the highest rate, 20%. How much your tax rate is on dividends depends on what your level of income is, but the highest rate is 20%. So dividends, again, I kind of mentioned a few things here, not deductible by the corporation. And so dividends are taxed at a rate of typically 15%. Most people would be in the 15% range. High income earners at the 20% range, and everybody else would be at the 0% range. And I'll just give you the qualification that I have not done personal taxes for a very long time. I've not ever taught the class. I'm aware of a lot of the ins and outs, but as the new tax law went into effect last year, I'm not up to date on all the exact changes that have happened. But I do know that the maximum rate is 20% for when you receive a dividend, but most people, the vast majority of dividend holders, would pay 15%. So basically, then you have to compare a C corp versus other business forms, and the question for a lot of business owners becomes, what form should I choose when I go through and start my business? What would be the best form for me in terms of taxation? And there's no one easy answer. There's lots of business forms. There's lots of different types of businesses, both in what they do and their size. And so there's no easy answer to that question, but the things to consider would be tax rates, what kind of income it is, that matters. If there will be losses, quite often when a business first starts, they're generating losses. Employment taxes and state taxes. Will you have a lot of employees, a few employees? Will just a couple of people as owners be doing most of the labor? And then, of course, you have to always keep in mind what your state and local tax situation is too. Living in South Dakota, we're a low tax state. We don't have a state income tax or a city income tax or anything like that. to worry about, but most states do. The vast majority of states have some kind of a state income tax and various other taxes that would, come into play as a business decides what form that they should be. So the corporate income tax rate, 21% flat tax. Historically, it was very different. It was actually between, I said 39% earlier, it was 10 to 37% is what it was in years prior, before the new tax law came into effect. So basically, 17 and prior was the old rates, 18 and going forward is the new 21% rate. And this shows you what the old rates were before 2018. So 17 and prior, that was what you did. That was the various different progressions you had to look at in your taxable income and then pay a rate. So 38%. Oh, there was a 39%. I knew there was. So 39% was right here. Kind of an odd tax code that it was built that way. And there's lots of reasons. The book mentions a few reasons why the tax code changed. I don't want to get into politics or anything like that, but generally, most corporations, or I should say most countries, overseas. So, and we live in a global economy. The things we use on a day-to-day basis, many of them were built somewhere else and brought to the U.S. But many other countries have corporate tax rates that were much lower than the U.S. Therefore, many companies were leaving the U.S., building factories other places, and then not bringing the money back that they made to the U.S. So the goal was to kind of make us more competitive globally with other countries when it came to tax rates and give companies an incentive to build factories in the U.S. again. So that was, the overarching reason for it. I don't want to get into politics, but it is important to kind of have a basic understanding of why this was done. Then again, I kind of mentioned the liability piece. Obviously, sole proprietors and partners have unlimited liability. That's a downside, whereas the S corps and C corps don't have that. And then also, sole proprietors and partnerships have a harder time accessing capital markets, right? It's harder to get capital infusion. If I'm a corporation, though, it's easier to sell an ownership interest. I can sell stock if I'm a corporation. Even a partnership could admit another partner who has got money. Maybe they don't want to manage the company, but they've got money to invest, and that's their return is going to be the investment, where other partners, their labor would be the return on their investment. And of course, transferability. The nice thing about stock, it's easy to sell. You can sell C Corp stock within seconds. I mean, if you have a trading account, it's really easy to sell stock. You know exactly what it's worth. It trades every day. But anything that's privately owned, the question is, what is it worth? How do you determine what it's worth? How hard is it to find somebody willing to buy shares of my company or buy into it? It's kind of like real estate, right? So if you have a home, you got to go through an appraisal and figure out what it's worth. You got to find somebody willing to buy your home who believes it has a good value, it's the right location, things like that too. So, and then sole proprietorships and partnerships do not have an indefinite life. Once the owner dies or the owner just decides, I don't want to do this anymore, the business ends. Whereas with corporations, we all know they have an indefinite life. Also, when it comes to management, the reason that partnerships and sole proprietorships, those are by far the most popular business forms in the country. The vast majority of businesses are some kind of a partnership or sole proprietorship. And the reason for that is the ease of creation. They're very easy to start. And the fact that the owner is now the manager, right? So the unification of ownership and management, those are big deals. And that's why they're the most popular. Anytime you begin to incorporate, you now add layers of management. You now have a board of directors, and things have to run through the board. They hire senior management and so on. We all know how that works. So it's good and bad, and depending on how you look at it. But a very popular form now is LLCs, limited liability companies. In fact, quite often I have students ask me, if I start a business, what form should I use? And I generally point to this one, LLCs. You do have to have a legal document, so it's a little bit of money to get that done, but it's not cost prohibitive. You can go to a lawyer who can do this for you. You can go through a LegalZoom.com website to get these done. And then you have to file it with the Secretary of State, with whatever state you incorporate in. In South Dakota, it's like a $50 filing fee every year. So these are not cost prohibitive, but they give you some advantages. The major non-tax advantage is that you avoid unlimited liability. So if you have an LLC and you go out and get a bank loan, it's the LLC getting the loan. Okay, now the banker could tell the owners, your LLC doesn't have enough income or assets that we're going to give you a loan, so you might have to personally guarantee it. So that could happen. But in theory, if the LLC gets a loan, unless the bank specifies otherwise, only the LLC's assets are at risk, not the owner's personal assets. The tax advantage, again, it's a flow-through entity. If the business itself does not pay tax, the owners do. It avoids double tax. So it's a very popular business form, probably the fastest growing business form that's been out there. The book mentions a few things about entity classification from many, many years ago. It says here prior to 97, and the next slide mentions the same thing. And what the IRS did was create what they call check the box regulations. And so if there's a question about how you want your business form to be taxed, they kind of give businesses the ability to choose. So even if you are set up legally as one business form, with some exceptions, you can choose to be something different. So you can choose to be unincorporated or corporated, depending on how you want to go and elect. And it's just literally checking boxes on an IRS form and filing that. That's why they call it the check the box. So just kind of be aware of that. I'm not going to get into, you can read through the chapter on that one. I'm not going to get, you can, it's very straightforward, so I'm just not going to talk about that one. Okay. Now, the rest of the chapter is going to focus primarily on qualified business income. It says, so this is new, and this is under the TCJA, the Tax Cut Jobs Act. I forget if I'm saying that exactly right, but that was a law passed just this past December. And that, again, and I should have mentioned, I didn't, it's the Tax Cuts and Jobs Act, TCJA. And that was the most sweeping tax reform since 1986. So the last time there was tax reform as sweeping and as changing as what just happened last December was 1986. So it's been that long, very, very long time. So a lot of this is new. So a lot of what's the rest of Chapter 2 is very new territory. So just keep that in mind. It's new for me. It's new for you. And so they call it Section 199A, Qualified Business Income. So this was a new code added to the Internal Revenue Code. Allows a 20% deduction on qualified business income for non-corporate taxpayers. Okay, it's potentially available to individuals, trusts, and estates, and we'll get into trusts and estates later on too. There's a couple of chapters towards the end of the class where we'll get into those. It's temporary. Now this is only good until 2025. So this was not a permanent provision. All the political ramifications of that we can worry about later. But it's for the next 7 years it's there. So it is 100% going to be there until 2025 unless Congress renews it between now and 2025. So we'll see. Okay. So just want you to be aware of that. And in the bottom part here, it says appreciating the purpose of the deduction to reduce the tax on business income derived outside of the C corporate form will help in understanding this provision. So the goal, so the C corp is that 21% tax. Okay. But we've got these other business forms where the owner is paying the tax or pass through, right? So the C corp is not a pass through. It pays 21% now. But you've got the LLCs, the S corps, the proprietorships, and the partnerships that are pass-throughs. So that business income goes to the owner's personal return. And so the goal is to reduce that tax, okay? But that has to be changed at the owner's personal return level. So there's some general rules here, and just keep in mind that a lot of these rules are still kind of up for debate in terms of what they mean. So, that's going to require court interpretations, IRS deciding what things are, and so on. But just be aware that we've got a few things like that. So the deduction for qualified business income is 20% generated through a sole proprietorship, a partnership, or an S corp. Okay, and then in general, the deduction qualifies for qualified business income as a lesser of 20% of QBI or 20% of a modified taxable income. And then this is the last deduction from your AGI, your adjusted gross income. And those of you who just got done with the personal tax class, you know what AGI is, your adjusted gross income. Basically start out with your gross income, make all of your deductions, all the, your standard deduction, your exemptions, your itemized deductions if you take those, and you get down to your AGI. Well, this is the last thing before AGI. And so the last step before determining what taxable income is for the owners of an S corp, sole proprietorship, or partnership. So think of it from that lens, and I think that will help you figure it out. There's 3 limitations. It's based on your modified taxable income. If you're a high earner, so basically a limitation based on modified taxable income. Another that applies to high income taxpayers, and then some kind of service businesses. So some kind of service businesses have some different rules here. I just love it when they make special exemptions, right? It just makes everybody's life more complicated. But when you rely on Congress to do something, you get those kind of rules. The second and third only apply when taxable income before the QBI exceeds these 2 numbers here. And this is for 18. So this is what you'll get in your homework for this class is 315 if it's married filing jointly, or basically half that, 157.5 for everybody else who is either filing single head of household or married but not filing jointly. In all cases, Section 199A may not exceed 20% of modified income. Modified income is taxable income before deduction for QBI, reduced by any net capital gain. Okay, so net capital gain is both net capital gain and the excess of long-term capital gain over short-term capital loss, plus any qualified dividend income. So there's a lot going on there. Okay, and just keep that in mind. So now this. Really, the whole rest of the chapter is all about QBI. So it's really important you read that. They give you lots of really good examples in the chapter too about what QBI is. I should also mention, back on page 9 of your chapter, they talk about the challenges of lowering tax rates and just kind of what the mindset was of those in Congress who were working on this law. What they were trying to figure out about how to reduce tax rates for these pass-through businesses, so the non-Schedule C types of businesses. So that mentions that, and page 10 mentions a few things about that also. Okay, so QBI then, what is QBI? The ordinary income less ordinary deductions the taxpayer earns from a qualified trade business. Okay, so basically, I'm a 1040 filer. I've got some kind of a business, sole proprietorship, S corp, partnership, and that's my QBI. That's my qualified business income. Does not include some things though. So it does not include capital gains or losses, does not include dividends, does not include interest income, okay, and certain other investments. It does not also include reasonable compensation. So let's just say you own a sole proprietorship or partnership and you receive a paycheck from that business. That's not included in this, or what we call guaranteed payments for services rendered, which we'll get into what that is in the partnership chapter. So then we've kind of already mentioned the limits here. These 2 numbers came up before. If you fall below, for tax papers to fall below the critical taxable income thresholds, the scope of the qualified trade or business is very broad. Basically, any trade or business other than providing services as an employee. Okay, so if you're an employee, that's different. But if you're an owner, different story. As a result, deductions available to sole proprietors, independent contractors, non-corporate owners of S corps, partnerships, and LLCs. So almost everybody but the C corps, okay, because the C corps are already taxable entities. High-income taxpayers who are engaged in businesses involving the performance of services in certain specified fields are subject to restrictions. And they'll show us what those specified fields are. And of course, obviously, some people own lots of businesses, right? They have their hands in all kinds of businesses, and some they're a majority owner, some maybe they're a minority owner or a 50-50 owner with another business. There's lots of people that I know in that situation. It says deductions for qualified business income must be determined separately for each qualified trade or business, and then you combine them all together. So you just have to go through business by business to figure out, is this QBI, yes or no? And if the answer is yes, you just add them all together. So here are the limitations. So 2 independent limitations. One is based on wages and capital investment. The second one is what kind of services are being provided in the business. So you can see a lot of service industries, doctors, dentists, lawyers, accountants, consultants, investment advisors, entertainers, and athletes don't get this. Okay. Engineers and architects, though, do. Why? Who knows, right? You got to read the mind of a congressman, and nobody wants to do that. And you can see again, they show us the number of limitations right there. They're fully phased in once taxable income before the QBI exceeds these 2 amounts, $415 for married and $207.5, half of that for everybody else. Okay, so you can do a phase in at some point too, and that's what a lot of your homework problems will be based on, is this phase in. Okay, and they show us lots of examples of that phase in and how it's calculated in the chapter. And they do a really good job then on pages 12 and 13 of your book of kind of walking you through what the qualified businesses are, what some of the income items are to think about too. And they've got some basic computation to show us on page 13 that I think you'll find good. And they show us the limitations on page 14. So you want to make sure you look at those as you do your homework. And then on page 15, they've got a flow chart. And flow charts about tax stuff are always exciting. I can just feel it. But just make sure you take a look at that too. So page 15, which is concept summary 2.2, it's a flow chart about the QBI deduction and how you kind of go through the process of figuring out, does somebody get it or not? And is some of it going to be phased in? Did you get some of it or not, or all of it, and so on? But just make sure you're taking a look at that. So limitations now. Remember, if you're receiving a W-2 wage, you can be an owner and still receive a salary from your business. Not every owner does. It's up to the owner how they want to do it. But if you're receiving a W-2 wage, that's a different story. Okay, and it also mentions retirement and deferred compensation. So those are some of the limitations on that. Qualified property includes depreciable, and then we have to talk about property too. And as you walk through some of the examples in the chapter, they'll mention owners of certain businesses, like they talk about a landlord who owns a rental property. So they talk about the value of the property, the land of the property, and how that might factor into what the QBI deduction is also. So that's what they mean by capital investment, is tangible depreciable property. Then another thing is with the phase in, if taxable income before QBI is less than the threshold, the limit does not apply. But if it's more than the threshold, then we have to look at the W-2 wage and capital investment limit. If taxable income before the QBI deduction is between the 2 amounts, the W-2 wage and the investment of the QB1, then we use the QBI amount is used, not reduced, but reduced as follows. I should say 20% of the W-2 wages and capital investments. So, the point is, I think one overall reaching point to remember when it comes to taxation is when there's limitations, you're doing calculations, whatever calculation results in the most tax is usually the one the government wants. Okay, so just FYI. Okay, so we're going to see a few of these, and the answer that wins is typically the one that results in the most tax getting paid. Okay, so just FYI, that's kind of just one overarching theme of any tax class, kind of no matter when you take it. What you see on the screen here is on page 17. So this is phasing in the wage and capital investment limit, and that's the formula you'd go about doing that. I know it's kind of hard to see, it's a little fuzzy, but it's on page 17 of your chapter, and this is obviously slide 41 of the PowerPoint if you want to have that open too. But it says taxable income before the QBI deduction minus the threshold amount divided by $100,000 married filing jointly or $50,000 for everybody else. Okay, so that's part of how you calculate what that is. And then we've got that specified services, right? So we talked about what some of those specified trade services are. And I mentioned a few, and this kind of takes those ones you mentioned earlier and expands on that a little bit. We mentioned doctors, and lawyers. This is health, law, accounting, actuarial, performing arts, consulting, athletics. Professional athletes. You can see what all those are right here. And for whatever reason, architects and engineers were excluded from that. I don't know why, but they were. Apparently, their lobbyists are really good. And then this mentions the phase-in of the specified services limit, and this is on page 19 of your chapter. You can see here it says taxable income before the QBI minus the threshold, again divided by $100,000 married filing jointly or $50,000 for everybody else. And then treatment of losses. So if a taxpayer has a qualified business loss in 1 year, no QBI is allowed. The loss is carried over to the next year to reduce QBI for the next year, but you can never reduce it below zero. Okay. QBI is allowed only for income taxes. Okay. As a result, the QBI does not reduce tax base for self-employment taxes or what they call the net investment income tax. In computing what they call alternative minimum tax, QBI does not come into play with that one either. So just a couple little rules to kind of be aware of. And then coming back to the big picture for Amy, our volleyball player who's going to start a business. Again, it says here we should maybe set her up as a sole proprietorship. If she generates losses, they can be used to offset other income that she might have. So if she's got some W-2 wages from somewhere, these losses would offset that and reduce her tax bill. If she has a part-time job until her business has enough income that she can support herself. So if she starts her business but keeps a part-time job just to have money coming in the door, these losses would offset her W-2 earnings and maybe reduce her tax bill by quite a bit. If the risks of her business, such as injury to customers, are minimal, she'll likely find that forming an LLC or corporation to reduce her personal risk is not warranted. But at some point, if it's the kind of a business where if there is the chance that somebody might become injured because of the business or something like that, she obviously should have insurance and have some legal protections to make sure that her personal assets are not at risk. Okay, and so that's a key thing to keep in mind too, depending on what kind of business it is. If she wants a more formal structure or legal structure to reduce personal risk, then an S Corp would give her the greatest benefit there. If she gets to be a really large company and big enough, she can go to Schedule C if she wants to. But then, of course, the QBI deduction does not apply if she's a Schedule C filer. So that's one thing to keep in mind too. She might be better off staying as an S Corp because she gets the QBI. And then, of course, we can't forget about state and local taxes and what those effects would be. I guess the nice thing about living where we live in South Dakota is we don't have to worry about that. Okay, so that was it. Hopefully that all made sense. It's really important you read the chapter. I know reading a tax book is not the most exciting thing, but there's really good examples in it too. So there's really good examples of the QBI stuff and the various limits and the phase-ins. Starting on pages 20 and 21 and 22 of your chapter. So you'll want to make sure you take a look at those. They will definitely help you a lot. Okay, as always, if you have questions, just let me know.